On September 20th, the Federal Reserve had their FOMC meeting where they discussed what the appropriate stance of monetary policy should be and assess the risk to its long-term goals of price stability. In other words, how to bring down inflation and how much they should increase interest rates by.
Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully.
If you watched my last video, by now you know that the Fed decided not to increase interest rates in their last meeting. But what I didn't talk about last time is the Fed's dot plot, which is a chart that shows what the 19 FOMC members think interest rates will be in the future. And that's what I want to talk about today. Hello and welcome to Ucash Finance. If you enjoy content like this, make sure to hit the like and subscribe button. It really helps out the channel. So 12 out of the 19 members think that by the end of the year, the Fed's fund rate should be between 5.5% to 5.75%, which would require a 25 basis point increase from the current 5.25 to 5.5%. In contrast, the remaining 7 participants believe that the rate should stay the same at its current level. So for the most part, they are all on the same page.
FOMC members, each dot represents a member here. They see interest rates peaking at 5.6% this year. Now that's higher from the March projection of 5.1%. So that
where the dot plot starts to diverge is in 2024 and 2025. In 2025, the expected target interest rate is between 2.5% to 4.25% on the low side, and between 4.5% to 5.75% on the high side, with an average target being 3.9% in 2025, which is a big drop from the 5.6% medium rate predicted for the end of 2023. This new dot plot from September 2023 suggested that the Federal Reserve is a bit more concerned about inflation in 2024 and 2025. When the Fed released their dot plot in December of 2022, only one member thought that rates would need to be higher than 4.5%, compared to now 5 members who think that rates need to be higher than 4.5% by 2025. When you hear different FOMC members saying they anticipate that the Fed's fund rate will be higher for longer, this is what they mean. One member, for example, is Minneapolis Fed President Neil Kashkari, who thinks the current Fed's fund rate of 5.25 to 5.5% is not restricted enough to stop inflation.
Are we sufficiently restricted right now or not?
I don't know.
Because some of the sectors in the economy that normally are affected by rate hikes seem to be ignoring them, such as auto and housing that look like they were preparing to bottom out but is now making a recovery. And things like consumer spending remain strong, and GDP came in higher than expected with 2.1% compared to the 2% which was expected.
So one thing that makes me cautious that we might not be as restrictive as we think is that consumer spending has remained robust, GDP growth continues to outperform, and the 2 sectors of the economy that are traditionally most sensitive to interest rate hikes, autos and housing, have both indicated some signs of bottoming and in some cases are starting to show some recovery. That makes me cautious that we might not be as restrictive as we otherwise would think.
And it's not just Fed members who think interest rates need to go higher. CEO of JP Morgan, Jamie Dimon, thinks that interest rates need to go as high as 7% and stated that if I was advising a company, I would say, are you prepared for 7% rates? Are you prepared for a recession? End quote. So what are my thoughts? In the beginning of 2023, Jamie Dimon said rates would go to above 5%, and now that rates are at 5%, he's saying that they can go to 7%.
I actually think rates will probably go higher than 5%.
Higher than 5%.
That's my own view.
This is why I wanted to explain the Fed's dot plot at the beginning of the video. The December 2022 Fed's dot plot showed that 17 out of the 19 FOMC members thought that rates would need to go to 5% or higher in 2023, which in hindsight, they were correct. But looking at the current dot plot, only one member thinks that the rate will be 6% or higher in 2024, and 7% is not even in the question. And that's just the first reason. The second reason why 7% is an insanely high rate is that it would make it more expensive for the US government to borrow money. As we talked about in the last video, the US basically runs on borrowed money to fund different programs such as education, housing, Social Security, Medicare, and emergency things such as flood relief. In 2021, the US paid $352 billion in interest payments towards the national debt. And in 2022, it was $472 billion. And in 2023, total interest payments are predicted to be $663 billion. And to really drive the point home, in 2030, interest payments are projected to be $800 billion. Can you connect the dots? Dot plot, get it? Just kidding. Let me know what you think about my jokes in the comments below. Overall, the economy cannot tolerate a high interest rate environment for much longer. This is why, according to the dot plot, majority of FOMC members are predicting rate cuts sometime in 2024, probably the summer of 2024 in my opinion.
Got a note in from Bank of America too. Their economist team now saying they don't see cuts until May 2024.
Taking all of that into consideration and taking the fact that risk assets such as stocks and Bitcoin do not thrive in a restrictive monetary policy, I am sticking to my plan. You heard me say it before and you are gonna hear me say it again. The only thing that I am buying at the moment is the S&P 500 because the average annual return in the long run is 10 to 12% annually. And in regards to my crypto portfolio, I am holding Bitcoin. Because similar to the S&P, Bitcoin's price has historically been going higher year over year. And there's so many positive narratives that is forming for Bitcoin, such as BlackRock filing for a Bitcoin spot ETF and Coinbase receiving regulatory approval to offer futures to international retail consumers, and so many more positive news and not enough time to discuss in the video, which is why you need to subscribe. Thank you very much, and I will see you next time.